Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, Wonderla Holidays Limited. I have some very interesting memories of this stock, and the stock has had a very interesting journey right from when it IPO'd in 2014 to 2021, the 7 years. And this journey of the stock has taught me a very important lesson, and which I'm going to share with you. And this lesson, I think, is one of the cornerstones of successful investing. If you understand this lesson properly and implement it with discipline, I think that is the difference between making average long-term returns in the stock market and very good long-term returns from the stock market. If you understand this difference and this lesson properly, so let's try and understand what this lesson is. Wonderla Holidays, it IPO'd in 2014. April-May 2014, price of 125 rupees per share, and EPS of I think 16-17 times, which I thought was slightly in the overvalued zone, if not extremely overvalued. But the investors who would have invested in the IPO and would have held on to their investments for the next 2 to 3 years, they would have made very good money in the stock market. The stock from 125 rupees per share went on to reach a high of 400 rupees per share over the next 2.5 years. But during this time, the earnings of the company hardly grew. Most of the growth in share price was supported by the expansion in price to earnings multiple, which expanded from 16-17 times at the time of IPO to 35-36 times at the time of the stock reaching 400 rupees per share. If I thought the stock was expensive at 125 rupees per share, I would definitely say that it was very expensive at 400 rupees per share. It was trading at a price to earnings multiple of 36 times, and there was no downside protection, and it was a very high price to valuations to pay for a company. But there was no dearth of investors who were positive on the company even at rupees 350-400 rupees per share. I even saw a brokerage report from a prominent brokerage house came out with the DCF analysis on the company. Stock was trading at 360 rupees per share. The target price was 460 rupees per share. And I found this report to be, very amusing, because the upside was 25-30%, but I felt that there was a huge downside risk to the stock if the company did not live up to its potential. And this is exactly what happened. From a high of 400 rupees per share, the stock over the next 1.5-2 years fell to rupees 230-240 rupees per share. A wealth erosion of whopping 35-40% from the top. And this is because the company was not able to meet the lofty expectations that was there in the stock price at 350 rupees per share. It was not able to grow at the rate at which the investors expected it to grow. Investors soon became impatient with the company, and they started selling the shares, and because of which the price came down to 40 to 50 rupees per share. Even at 230 to 40 rupees per share, I felt that the stock was expensive, and it was not the right entry point for the stock. Then came the crash, coronavirus-led crash, which saw the entire stock market crash, and of course Wonderla also. The stock fell from 240 to 105-110 rupees per share. Correction of more than 50% from 240 rupees. From 400 rupees in 2017-18 is correction of 75-80%. A huge correction in the stock price. Now at 105-110 rupees per share, I finally felt that this now makes the stock an attractive investment and not speculation. Very high on investment and very low on speculation, as compared to the price of 400 rupees per share, where it was very high on speculation and very low on investment attributes. This view was, of course, very different from what a lot of other investors thought. They thought that the investment was attractive at 350-360 rupees per share, but they felt the stock was risky at 105-110 rupees per share because there was near-term uncertainty. Now, why did I feel that the stock was an attractive investment at 105-110 rupees per share, and why did I end up recommending it to my subscribers? I felt that 110 510 rupees per share, it had a big margin of safety, which was absent when the stock was trading at 350, 400 rupees per share. Why did I feel that there was a big margin of safety? Because based on the normalized EPS of the company of 10 rupees per share, the stock was available at a price to earnings multiple of 10, 11 times, or an yield of around 10%. So at 10 rupees per share, it was giving me returns of 10%, which I felt was significantly higher from what I would get if I invest in an FD or in a liquid fund, which gave me 6-7%. So there was that protection cushion of 10% that I got from the stock versus a 6%, 7%, 6-7% that I would get by investing in FD or a liquid fund. So definitely a big margin of safety there, and which is why I felt that the stock was an investment and it's no longer a speculation, because I was reasonably confident that once the economy recovers and once people start going back to amusement parks, the company had managed to earn 10 rupees per share on a consistent basis in the previous 5-6 years. It will again be able to do so, once economy recovers, and once investors get back to their senses, and once they start valuing companies fairly, they would again take the stock price of the company to a reasonable price to earnings multiple of 16-17 times, which gave me the target price of 160-170 rupees per share. And here the company was available because of the crash at 105-110. There was real margin of safety available. Back in 2017-2018, I don't think there was any margin of safety available. There was no logical way to explain why a company like Wonderla deserved a price to earnings multiple as high as 35-36 times. Historically, if you would have paid 36 times for a company like Wonderla, which had grown very tepidly over the past 3-4 years, which had very little growth to show, and still command a price to earnings multiple of 36 times, if you make a lot of these similar kind of investments, you would have lost money, and therefore there was no margin of safety present. It was more a speculation than an investment. On the other hand, there was a solid logical argument in favor of investing in the company at a price of 105-110, because all I was expecting the company to do is at least earn an EPS of 10 times, 10 rupees per share. I wasn't even expecting the company to earn an EPS of 12, 14, 15 times, which of course would have been the icing on the cake. Even at 10 rupees, there was sufficient margin of safety present, because I was getting 6-7% investing in FD or a liquid fund, and here I was getting 10% at a price to earnings multiple of 10 times. If you invest in 20-25 such stocks where you're paying a price to earnings multiple of 10 times, significantly higher than what you get from FD or a bond, there will be 3-4 stocks which will disappoint. There will be a few stocks which will disappoint. If you're buying a basket of 25-30 stocks, when markets are attractively valued, when they have crashed, there's no reason why you can't make very good money over the next 2 to 3 years on a basket of such stocks, even if few stocks don't perform as expected. So this is a very important concept, the concept of margin of safety. This concept has to be supported by logical reasoning, solid argument. An argument that I made was, of course, against fixed deposits, which I think is a solid argument, and it has to be supported by the stock market history. Historically, if you pay 9 to 10 earnings multiple for small companies, micro cap companies, well managed companies, good balance sheet, decent managements, you would end up making money. Whereas it's very difficult to make money at 35-36 price to earnings multiple for a company that's grown modestly historically. And again, there is very little logic to support paying a price to earnings multiple of 36 times. So this is the difference, and this is the concept of margin of safety, which I think is very, very important for you to understand this concept properly. A lot of people make mistakes in understanding the concept of margin of safety properly. They apply it very loosely, but I think you have to understand this concept properly. Margin of safety has to be backed by sound logic, and it has to have a history of showing good performance historically in the stock market. So you have to apply this well, understand it properly, apply this well, apply it with discipline. If you do that, I think there's a very strong chance you may earn market beating returns in the stock market over the long term. People like Warren Buffett have become rich by applying this very principle. He understands the concept of margin of safety better than I think anybody else. Benjamin Graham, of course, who was the inventor of this, or who laid the foundation for this concept, believed that this is the margin of safety is something that separates investment from speculation. If you're understanding properly and if you're using it the right way, you are making a sound investment in the stock market, and there's a very good chance you will end up doing well. If you are loosely applying it, or if not understanding it properly, then it falls into the realm of speculation, and you're going to get a speculator like result if you don't use it properly. So apply the margin of safety concept properly. It is key to making good returns on the stock market over the long term. So that's all from me today. Do keep those likes, dislikes, comments coming, and I'll see you again next time. Thank you so much.
This is it. The only 20 stocks to own forever. Click here to reserve your free spot for our special event on Forever Stocks on 21st June at 5 p.m. IST.